What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing episode. In this episode, we're going to talk about 3 lower risk UK stocks that you can buy and invest your money into to keep it a little bit safer than what would be the market average at the moment. Based on the fact that we're in uncertain times, we don't know when we're going to come out of it. If you look at how the market is performing at the moment, it's up and down like a yo-yo or a kangaroo, as we're now referring to it, or a lot of market analysts are referring to it at the moment. So yeah, we have 3 animals for the market now. We have a bull market, a bear market, and then we have the description for this, which is the kangaroo market. Doing. Anyway, that being said, if this video brings you some value, please smash that like button in the corner there. If you're brand new here, it'd be absolutely fantastic if you could subscribe to my channel and even hit that notification bell if you're feeling super nice. That being said, let's roll the intro and get fully into it and have a look at these stocks. Catch you in there. What's going on again, guys? Welcome to the next part of this video, and as you can see, we have our first stock all lined up, which is Astrazeneca. Been in the news a lot lately due to the work that is ongoing with the health crisis and the search and the hunt for a vaccine, which is seeing this company's value spike quite a lot recently as investors try and anticipate who's going to come up with the vaccine first and where to put their money. However, what I've seen with this is that this company is a very strong long-term bet. If we look back over the last over its performance on the last few years or so, we get a absolutely awesome return over the last 7 years, and it continues just to trend up and up and up. It's a well-diversified company, is involved in way too many healthcare things to sound off, but there's a few just here that you can see in oncology, cardiovascular, renal, metabolic diseases, autoimmune diseases, infection. It's obviously working on its vaccine for the health crisis right now and has got a revenue stream to back that up, and that is where we're going to start there really. So we have, its ticker is AZN, has a market cap of 111 billion, a PE ratio of 70.91, revenue of 19.77 billion, an EPS of £1.20, and a dividend yield of 2.58%, and quite a healthy net income of 1.33 billion. Now, I would refer to this as like the UK version of Johnson & Johnson, not quite the dividend king that Johnson & Johnson is, but if you look at this performance here, and it is raising its dividend, it has raised it for the last 14 years or so. It's been paying for over 14 years, should I say. It trimmed back its dividend in 2011, but it then restored it straight afterwards based on better financial performance straight after, and then it's continued to grow it ever since really. And if we have a look here, its last 3 years growth has been 2.34%, which is not amazing, but it is guaranteed quite low risk growth where you can put your money and you know that you're going to get value for your money. And that is the sort of thing that you get with companies like this, is you pay a premium because of the safety net that you sort of have with these companies. That's why Johnson & Johnson sort of retains its value, and Pfizer and that side of things, because people are always going to need healthcare and healthcare products. It's currently trading at £84.97 a share. It's been popped up to £89 a share, and peak crisis it actually dropped down to £62 a share, which would have been an absolute bargain in my opinion, and I wish I had seen that one slightly earlier, but at that point there was way too many bargains out there to be had. That being said, I'm going to wrap this video up there, and not this video, should I say, this next part of this first part of the video, and I'll see you back in the real world. Sorry about that. What's going on again, guys? Sorry about that. I'm too keen to wrap this video up, apparently. I am here, I am present. I'm not trying to rush things, so to speak. It's just a minor mistake on my part, my bad. Anyway, that was Astrazeneca, a cool, well-funded, well-founded company and well-grounded company to keep your money and buy stocks in at the moment. And with a real low risk, and it's got a real diverse revenue stream, as well as that work that's potentially coming because they're working on a vaccine for the health crisis, and they're stockpiling. They're so confident in it, they're actually stockpiling vast amounts of the chemicals and drugs and etc. that they need to make it. They're actually stockpiling that already so they can mass produce it really quickly when it actually gets clearance and gets the go ahead. Moving on from that one, then we've got our next stock, which is Severn Trent. Everybody is going to need water and their sewage taken away, and this company absolutely does that, and does that particularly well in the Midlands area. Let's go in and let's have a look at their fundamentals. Catch you in there. Hello again, guys, welcome to the next part of this video, and here we have the fundamentals for Severn Trent. So as we can look over the long term, slightly more volatile than we saw with Astrazeneca. However, there is a nice upward trend overall, and based on what this company does, people are always going to need water and always going to need their sewage taken away and that managed. So what they provide is absolutely essential, so there's always going to be a need for that service, and this company is particularly good at it. That being said, let's have a little look at how they are doing. So they dropped to £20 a share peak crisis, and they're now back up at £24.60, and they peaked just before the crisis at £26.87, which would still, even if you'd have picked it up at then, you would have still received a pretty decent yield. Anyway, the ticker is SVT. They have a market cap of 5.88 billion, a PE ratio of 49.61, revenue of 1.8 billion, EPS of 50 pence, and a nice chunky dividend yield of 4.06% based on current share price. And they have a net income of £158 million, which is pretty good for a company that's revenue is 1.84 billion, but they've got shareholders to satisfy, and it's quite expensive to manage a water and sewage system in terms of the engineering cost of doing so. They have been paying their dividends for well over 14 years and consistently paying them for 14 years. They've not raised a great deal. Sometimes they trim down a little bit, and the actual chart was like a bit higgledy-piggledy. It's not the sort of upward curve that you would normally want to see. However, there was no major cuts in that time. They just sort of sliced off a little bit and then added it back on another year. So it's not a it's not a consistent grower, but it has, the trend actually is upwards overall. If we just have a little look at the growth here, they've sort of become a bit static of late. So their revenue is up 4% over the last 5 years. But their dividend growth has actually remained static over the last 3, where they haven't really raised it, but that's because it's already at a good 4%, and it doesn't, in the company's opinion, it probably doesn't need to go much higher than that. Most people are happy to buy and hold on to a 4% yield, as long as they don't cut it down, especially if you were to buy in at a lower rate down here, then you've got a very good stable income stock there. And that is what most dividend investors want, is just stability. You're going to receive your money, you're going to be able to reinvest it month on month, year on year, for however long you hold the company. Now, when I buy into this company, I plan on holding it for a very long time, and that is because they are actually my water company, or they were when I lived in Birmingham. So yeah, it'd be nice to have them pay, like the money circle, it'd be nice to have them pay me back, and then I pay for my water bill and the circle continues. That being said, let's wrap this little sector up here, and I will see you on the other side. Hello again guys, welcome back to the real world. That was Severn Trent there then. A very consistent dividend payer, has always paid a dividend for a very long time now. Now it might not have gone on this lovely little exponential curve that we would all like to see, but what it has done, the trend is still upwards. It just goes up a little bit, then down a little bit, up a little bit, down a little bit, then up, and then it's up again in the most recent years, which is obviously very good for us and is very stable in terms of doing so. And it's a nice high yield of 4% as well, which is good, which means we're going to get a solid payout and make it all worthwhile. That being said, we're going to move on to our last company now, and this is actually a company that is approaching Dividend Aristocrat status here in the UK, which is absolutely fantastic. We don't actually have that many, though we have a lot of high yield dividend payers here in the UK. We don't actually have that many that have consistently grown their dividends for so long and remain so committed to doing so. Although we get quite high yields here, our companies over here in the UK seem to cut their dividends a bit willy-nilly as soon as there's a sign of a problem, which is a good thing because it's usually good for the financial health of the company if they're doing so, or it means that they're not doing so good, and that's obviously a bad sign. You want companies that are like Dividend King status over in the United States, or Dividend Aristocrats, where they've consistently grown that dividend for so long, and that just is a real good sign of a really mature product, a really mature style of management, and a mature company that is just a cash cow for us investors. And that is what I think we miss a little bit here in the UK. It would be great to see more Dividend Kings and Aristocrats over here. However, I digress a little bit, but Croda here is definitely one of them. It has been growing its dividend for over 20 years, which is absolutely fantastic. Now the caveat to that is that the yield is actually quite low, a low starting yield. So you're starting, looking at my research here, based on 1.7% or so, which is obviously quite low, but it is growing year on year. And when I take you in there to the analysis in a second, you'll see what I mean about that. And their share price growth has been great with that too, which has also kept the yield down. This company is fantastic. I feel like I've unearthed it a little bit. I hadn't even heard of it before I started doing my research today. It's actually one that I really want to look into. It's a chemical company, and it's got a fantastic dividend reputation. Even though you have to take the hit initially on a low start point, it is consistently good, and that is what and consistently growing, which is what we want as dividend investors and dividend growth investors. That being said, let's roll on in there and let's have a look. What's going on again, guys? Thank you for joining me in this penultimate part of this video and this episode. It's fantastic to have you here again. So here we are looking at this glorious company, Croda International. I feel like I've found a bit of a diamond in the rough here. If you just look at that chart overall, it's absolutely brilliant. And even in the midst of the crisis that we had, it has performed the ultimate V-shaped recovery. Dropped down to £40 a share at one stage. Absolute bargain that would have been, and then it's bounced back in the time period since the crisis began in February, back to where it is, and performed to the proper V-shaped recovery that a lot of people were talking about. Croda International is a UK-based chemical company, specialises in offering chemicals for personal care in terms of skin, hair, sun protection, colour, cosmetics products, used by a whole array of companies to base their products on, and they're actually based in the biotechnology and drugs industry. That being said, let's have a look at their fundamentals. So their ticker is CRDA. They have a market cap of 6.73 billion, a PE ratio of 28.42, revenue of 1.38 billion, EPS of £1.84, that's quite high. There's the dividend yield that I was on about earlier in this video at 1.72%. And then they have a net income of 223 billion and a double-digit profit margin of 16.25%, and a very low debt to assets ratio there of 54%, which is really good based on the size of the company. As I said earlier, they have been growing their dividend for 20 plus years, which is awesome. And we're just going to have a little quick look at the 5-year performance. So they've been growing, their revenue has been growing 5.65% over the last 3, 3.47% over the last 5. In terms of per share, that's 6% over the last 3 years and 4.63 over the last 5. And their dividend growth rate over the last 3 years has been 5.83%. And then my information from dividend data suggests that they have been growing it over 5 years at 6.5%, and their 10-year dividend growth has been 15%, which is absolutely awesome. Such a good company. I'm really glad that I've found this one, and I'm absolutely almost certainly going to add this to my portfolio as soon as I get a chance and the funds to do so. I mean, I just can't get over its performance and how it's got on over the last 8 years has just been absolutely incredible. Dealing with the crisis like it has in a V-shaped recovery, growing its dividends for so long, it's almost a no-brainer for me. Of course, do your own analysis, do your own research, but for me this is absolutely awesome, and being based in the UK as well, that is just perfect. Slow and steady wins the race in my opinion sometimes. Like I said, I do like a few speculative stocks, but when it comes to long term, this is the sort of company that you want in your portfolio, 100%. That being said, I'm going to stop singing its praises now, and I'll catch you back in the outside world. Hello again guys, welcome back to the real world, and this is the final part of the video. Croda International then, absolutely fantastic company. As you can probably tell, I can't sing its praises enough really, which is really good. It's actually finally a company that I can in confidence say can go toe to toe with some of the Dividend Aristocrats and Dividend Kings from America in my portfolio, and I can be confident in its performance in the future based on looking at how it has done in its past. Obviously past performance is never an indication of future performance, but it does give you a little bit of an idea of how the health of the company, and that is a really good indicator in my opinion, looking at the fundamentals that we did there. So it's absolutely a winner for me, that one. And you're paying a premium for it because the price has recovered, but if it ever did pull back slightly and go back to crisis levels, I would in a heartbeat snap that company up at that price. I'm happy to pay the price it is now, so being £10 cheaper, I would gladly take that on as well. That brings to an end this video. It'd be really great if you could hit the like button in the corner there for the YouTube algorithm, and for me to get this video out to more people and help the channel out. If you're brand new here, please hit the subscribe button in the other corner there, and even tick that notification bell if you're feeling super generous. It'd be fantastic to see you in another one of my episodes, and I will finish there. It's been a pleasure to bring this video to you, and I'll catch you in the next episode hopefully. See you later. Bye bye.